The world woke up today to a financial confession that changes everything. This isn't speculation. This isn't theory. This is forensic evidence of a system in collapse. We have received multiple confirmations. We have analyzed the vault data, and we have cross-referenced the global pricing structure. What we are about to show you is the most comprehensive breakdown of the crisis that is currently unfolding in the silver market. A crisis that the establishment hoped you would never understand. Today is Wednesday, January 14th, 2026. And today, the illusion shattered. For 50 years, you were told that the price of silver was determined by a computer in New York. They told you that paper contracts, high-frequency algorithms, and derivative leverage were the real mechanisms of price discovery. They told you that physical supply didn't matter because there was always enough metal to go around. They told you that the shortage was a myth, that the premiums were temporary, and that the system was stable. They lied. We now have official documentation that proves the pricing mechanism is broken beyond repair. We have vault withdrawal data that reveals a bank run at the wholesale level, and we have confirmed pricing from Shanghai that exposes a two-tiered market where the Western paper price and the Eastern physical price have diverged so violently that the arbitrage gap is sucking every available ounce of metal out of the United States. This deep dive is structured in 4 critical sections. In Part 1, we will decode the sovereign confession. We will analyze the official communication from the United States Mint and explain why their suspension of silver sales is not a pause but a default. In Part 2, we will examine the wholesale panic. We will walk through the vault drain data and identify who has the power to withdraw 1.3 million ounces of silver in a single day. In Part 3, we will expose the Shanghai reality check. We will show you the proof that silver is trading at $100 per ounce on the physical market, while the COMEX screen shows 88.845. And in Part 4, we will map the endgame. We will explain what happens next, where the price is going, and how you position yourself before the window closes permanently. If you stay with me through this entire analysis, you will understand the magnitude of what is happening. You will see the forensic evidence. You will know why the government cannot price the metal. You will know why the vaults are empty. And you will know why the Western financial system is being forced to surrender pricing power to the East. The wealth transfer has begun. Let me read you the exact language from the official notification sent by the United States Mint to its customer base. Quote, "Due to metal costs, pricing adjustments are being evaluated across all numismatic products. We are currently unable to offer these products for sale and will resume when pricing has been updated. To the uninformed observer, this looks like a routine administrative update, a pricing glitch, a temporary delay. But to the forensic analyst, this is a confession of systemic failure. This is a physical default at the sovereign level. Let me explain what this actually means. The United States Mint is not a speculative hedge fund. They are not a day trader. They are a manufacturing entity with the full backing of the United States Treasury. Their job is simple: Buy silver from the wholesale market, stamp it into coins, and sell those coins to the public at a predictable markup. This is a process they have executed without interruption for decades. But today, they stopped. Why? The official reason is pricing adjustments due to rapidly rising metal costs. But let's think about what that actually reveals. If the United States Mint, with all of its institutional resources, cannot figure out how to price a 1 silver coin in real time, it means the volatility of the market has exceeded the capacity of the bureaucracy. It means the price on the screen, currently trading at $88,845, is moving too fast for the government to catch. But there's a deeper, more terrifying implication. When a business stops selling a product during a price spike, it is usually because they cannot replace the inventory. Think about the mechanics of the Mint's operation. If the Mint sells you a silver eagle today for $90, but the price of silver gaps to $100 tomorrow, they have lost money. More importantly, they have lost the ounce of silver. And if they cannot go into the wholesale market and buy that ounce back because the refiners are empty, the dealers are rationing, and the vaults are being drained, they are effectively liquidating the national wealth for depreciating paper currency. They have realized that the silver is worth more than the dollars. This suspension is the break glass in case of emergency signal we have been warning you about. It is the moment where the paper price and the physical reality diverge so violently that the system simply freezes. We are now in what market analysts are calling the no-offer phase of the bull market. Let me give you an analogy that makes this crystal clear. Imagine walking into a grocery store. The shelves are full of milk and bread. The products are sitting right there in front of you. But when you go to the register, the clerk refuses to sell it to you. He says, "I'm sorry, the price of milk is rising too fast. We are suspending sales until further notice." What does that tell you? It tells you that the currency is failing. It tells you that the store owner would rather keep the milk than take your cash. That is exactly what the United States government just did to you with silver. The Mint suspension creates a psychological shock wave that will travel through the entire dealer network. The private dealers, AppMax, JM Bullion, and SD Bullion. They look to the United States Mint for guidance on supply and pricing. When the Mint closes its doors, the private dealers panic. They realize that their primary source of silver eagles, the most recognized and liquid coin in the world, has just been cut off at the source. This creates an immediate scarcity loop. Dealers will raise their premiums to protect their remaining inventory. If they cannot get more eagles from the government, they have to ration the ones they have. We are already seeing premiums on eagles crossing $10 over spot. The street price is completely untethered from the $88 COMEX price. And this brings us to the current chart. While the Mint is frozen, the market is moving. Silver is trading at $88,845 per ounce. We are up $2,507 today. That is a move of nearly 3%. We are knocking on the door of $90. The market smells blood. The traders see that even the United States government is scrambling to secure metal, and they are fronter running the inevitable repricing. $90 is a psychological level, but the real level, the level that matters, is $100. The suspension at the mint guarantees that we will hit 100. Why? Because it removes a massive source of supply from the retail market. Thousands of ounces that would have been sold to the public today are now sitting in a vault locked away. That demand does not disappear. The people who wanted to buy eagles today still want to buy them. In fact, they want to buy them more because they have been told they cannot have them. This pent-up demand will spill over into other products. It will spill into bars. It will spill into rounds. It will spill into the broader investment market. It creates a vacuum effect. The United States government has inadvertently launched the biggest marketing campaign for silver in history. By telling you that you cannot buy it, they have confirmed that it is the most valuable asset you can own. So, where do we go from here? The mint says they will resume sales once pricing has been updated. Do not expect that price to be lower. When they reopen the window, the price will likely be substantially higher. They are repricing for a new reality, a reality where silver is a triple-digit asset. This event is the demarcation line. Before today, we were in a supply squeeze. After today, we are in a sovereign crisis. The entity that prints the money cannot find the metal. If that doesn't tell you everything you need to know about the state of the United States dollar, nothing will. The mint is folded, the dealers are rationing, and the price is vertical. But if the mint closing was the defensive move by the establishment, what is happening in the commercial vaults is the offensive move by the whales. While the government was shutting down retail sales, a massive entity drained 1.3 million ounces of silver from the vaults of J.P. Morgan Chase. In this section, we are going to analyze the vault drain. We are going to look at who has the power to withdraw that much metal in a single day, and why the drain of the eligible category is the death knell for the COMEX pricing mechanism. We have analyzed the daily depository statistics from the CME group released late yesterday. The data confirms a coordinated raid on the stockpile of J.P. Morgan Chase. J.P. Morgan is not just another bank in the silver market. They are the fortress. They are the custodian of the largest hoard of silver in the COMEX system. For over a decade, their vaults were considered the backstop of the market. Yesterday, the fortress was breached. 132,870 ounces of silver were physically withdrawn from the J.P. Morgan vault. This metal was not adjusted. It didn't just move from one accounting column to another. It was withdrawn. That means it was loaded onto armored trucks, and it left the building. It is gone. It has left the COMEX ecosystem entirely. Who has the power, the capital, and the logistics to move 40 metric tons of silver in a single day? This is not a coin dealer. This is not a retail investor buying a few tubes. This is a whale. This is a sovereign wealth fund, a central bank, or a massive industrial conglomerate. And it wasn't just J.P. Morgan. The data shows the bleeding is systemic. 600,000 ounces were withdrawn from the Brinks vault. 200,000 ounces were withdrawn from the CNT vault. 259,000 ounces were withdrawn from the Loomis vault. In total, across all depositories, the COMEX lost nearly 1.8 million ounces of silver in a 24-hour period. This is a bank run, but instead of people lining up at an ATM to withdraw cash, we are seeing strategic entities lining up at the warehouse to withdraw bars. They're doing this for one reason: counterparty risk. The entity that took 1.3 million ounces out of JP Morgan knows something. They know that the paper price on the screen, 88.845, is a fiction. They know that the inventory reports are thinning. And they know that if they leave their metal in the vault, it might get encumbered. It might get leased out. It might get rehypothecated to cover the massive short positions of the banks. So, they are taking possession. They are following the golden rule: if you don't hold it, you don't own it. But there is a deeper layer to this withdrawal that is even more bullish for the price. We need to look at where this silver came from inside the vault. In the COMEX system, there are two categories of silver: registered silver, which is available for delivery against futures contracts, and eligible silver, which is privately owned metal just sitting there for storage. Usually, when we see a squeeze, we watch the registered category drop. And indeed, registered stocks dropped by over 500,000 ounces yesterday. But the bulk of the JP Morgan withdrawal came from the eligible category. Why does this matter? Because eligible silver is supposed to be sticky. It is owned by long-term investors who pay storage fees to keep it there. It is not supposed to move. When eligible silver starts leaving the vault in million blocks, it means the old money is getting out. It means the long-term holders have decided that the COMEX is no longer a safe place to store their wealth. It suggests that the trust in the institution of the exchange has collapsed. And where is this metal going? We can make an educated deduction based on the global price map. We know from our data that the price of silver in China is hovering between $98 and $100. We know the price in New York is $88.845. That is approximately an $11 arbitrage gap. If you are a strategic entity holding silver in New York, and you can sell it in Shanghai for $1 more, you ship it. You drain the West to feed the East. The 1.3 million ounces that left JP Morgan yesterday are likely on a cargo plane right now heading across the Pacific. They are moving from a market that suppresses the price to a market that pays the fair value. This drain creates a mathematical limit on how long the suppression can last. The banks can print infinite paper shorts, but they have finite physical ounces. Every day that the arbitrage window remains open, another 2 million ounces leaves the system. At this rate of withdrawal, the effective available inventory on the COMEX will be critical within weeks. This connects back to the United States Mint suspension. The Mint cannot find silver to make coins because the wholesale silver is being hijacked by these massive withdrawals. The retail supply chain is downstream from the commercial vaults. If the commercial vaults are being drained by whales, the river runs dry before it reaches the retail investor. You are witnessing a crowding out effect. The big fish are eating all the food, and the little fish, the retail buyers trying to get a silver eagle, are left starving. This creates a terrifying setup for the price. We are at 88.845. We are up nearly 3% on the day, but we are doing this on vapor. We are trading paper contracts that represent metal that is rapidly disappearing. The JP Morgan drain is the smoking gun. It proves that the smart money is not selling at $88. They are taking delivery. If they thought 88 was a bubble, they would be selling their metal into the market to cash out. They would be increasing the stockpiles, not decreasing them. The fact that they are withdrawing metal at all-time highs tells you exactly where they think the price is going. They think 88 is cheap. They think 100 is cheap. They are preparing for a repricing event that will make the current move look like a rounding error. So, we have the government shutting down sales. We have the banks losing their inventory. This leaves only one variable left to analyze: the price. How high does the price have to go to stop the drain? How high does it have to go to convince the whales to put the silver back into the vault instead of taking it out? It has to go higher than Shanghai. It has to go higher than the street premium. In this section, we are going to look at the Shanghai reality check. We have confirmed reports that physical silver in China is trading between $98 and $100. We are going to analyze this two-tiered market and explain why the COMEX price has no choice but to gap up to 100 immediately. We have arrived at the moment of truth. If you look at your trading screen right now, you see a number, $88,845. That is the price that the COMEX computer says silver is worth. That is the price that the algorithms are trading. That is the price the media reports. But we have received a reality check from the other side of the world that proves that number is a lie. We have confirmed data from the physical markets in China indicating that silver is currently trading between $98 and $100 per ounce. Let that sink in. There are now two prices for silver on planet Earth. There is the Western paper price of 88.845, and there is the Eastern physical price of 100. This is an arbitrage gap of approximately $11 per ounce. In the financial world, this is known as a broken market, and $1 spread is not an inefficiency. It is a vacuum. It is a black hole that is sucking every available ounce of metal out of the Western Hemisphere. Think about the physics of this trade. If you are a bullion bank, a refiner, or a trading house, you're looking at a risk-free money printing machine. You can buy a contract on the COMEX for 88.45, take delivery of the bar, fly it to Shanghai, and sell it for 100. You make an immediate guaranteed profit of over 12% in a matter of days. This trade is happening right now. It is the reason the vaults are empty. It is the reason the mint is closed. The metal is flowing uphill to the highest bidder, and the highest bidder is China. This signifies a historic shift in the structure of the global economy. For 50 years, price discovery, the mechanism that decides what things are worth, lived in New York and London. The West set the price, and the East took the price. Today, that relationship has inverted. Shanghai is now the price maker. New York is the price taker. China is setting the price based on physical supply and demand, based on the needs of their solar factories, their battery plants, and their citizens protecting their wealth. New York is just trying to keep up, dragged along by the arbitrage. This means that the price of silver on the COMEX must rise to 100. It has no choice. It is a mathematical certainty. If the COMEX price stays at 88.845, while Shanghai is at 100, the drain will continue until the COMEX has exactly 0 ounces left. At that point, the COMEX defaults. To prevent a default, the COMEX must close the gap. The paper price must rise to meet the physical price. This is why we are seeing such violence on the charts. This is why we are seeing vertical candles. The market is frantically trying to re-prick itself to reality before the inventory runs out. And consider the inelasticity we discussed earlier. Why is China paying 100? Why aren't they waiting for a dip? Because they know the dip isn't coming. The Chinese industrial complex understands that silver is a strategic mineral. They know that without silver, they cannot dominate the green energy transition. They are willing to pay 100, 110, whatever it takes to secure the atoms. They are not speculating. They are hoarding. This Shanghai reality check explains the panic we saw at the United States Mint. The United States Mint usually buys silver blanks from private vendors. Those vendors operate in the global market. Yesterday, the United States Mint likely called their suppliers and offered to buy silver at the spot price of 88.845, and the suppliers likely laughed at them. The suppliers said, "Why would we sell to you at 88 when we can sell to Shanghai at 100? The United States Mint got outbid. The sovereign government of the United States was priced out of its own currency market by the physical reality of the East. That is why they suspended sales, not because of a glitch, but because they refused to pay the real market price. And so, they got no metal. This is what a currency collapse looks like in the early stages. It isn't just about the number on the bill getting bigger. It is about the goods disappearing from the shelves because the currency is no longer accepted as a valid store of value by the producers. We are seeing the bifurcation of the world. A paper world that is crumbling and a physical world that is repricing. So what does this mean for the price action in the next 24 hours? With the Shanghai price hitting 100, the psychological ceiling for the COMEX is gone. Traders in New York know that 88.845 is a discount. They know that 90 is a discount. This creates a chase. Funds that are underweight silver, which is almost all of them, are scrambling to get exposure. They are buying the futures contracts because they cannot get the physical metal. This pushes the paper price up. It creates a feedback loop. The higher the price goes, the more headlines it generates. The more headlines, the more retail panic. The more retail panic, the more the mint stays closed. The more the mint stays closed, the higher the premiums go. We are in a super exponential phase. And let's look at the gold price for confirmation. Gold is trading at $4,622.60. It is holding its breakout. If you apply the historic gold to silver ratio to the Shanghai price of silver, the math becomes even more explosive. But right now, the ratio is compressing. Silver is outperforming gold because the shortage in silver is acute, whereas the shortage in gold is monetary. Silver is running out of stock. Gold is just being revalued. The Shanghai spread is the ultimate bullish indicator. You cannot fake it. You cannot paint the tape in Shanghai to fool the market in New York. Physical metal is heavy. It is hard to move, and it does not lie. If buyers in China are handing over $100 worth of yuan for an ounce of silver, then an ounce of silver is worth $100. Period. The COMEX can print 88.8, 845 on the screen all day long, but that just makes the COMEX a liar, and markets always punish liars. The punishment is the drain. The punishment is the default. We are watching the Western financial system being punished for 40 years of price suppression. They held the beach ball underwater for too long. Now it is rocketing to the surface, and it is going to hit them in the face. We have arrived at the conclusion. If you have been with me through this entire deep dive, you now understand the full magnitude of the event we are living through. You understand the sovereign default signaled by the United States Mint suspending sales. You understand the whale raid that drained 1.3 million ounces from the J.P. Morgan vault in a single day. And you understand the Shanghai reality where the physical price has already crossed the $100 barrier, leaving the COMEX trading in a fantasy land. The evidence is overwhelming. It is forensic. It is undeniable. We are not looking at a trading anomaly. We're not looking at a temporary supply chain glitch. We're looking at the end of an era. The era of cheap, abundant, paper-derived silver is over. It died today, Wednesday, January 14th, 2026. Now we must look forward. We must map out the territory that lies ahead. Because once the sovereign mint closes its doors, the rules of the game change permanently. We are flying into the vacuum. So where does this stop? Is 90 the top? Is 100 the top? To answer that, we have to look at the psychology of the triple digit. $100 is not just a number. It is a barrier in the human mind. For decades, silver has been seen as the poor man's gold, trading in the teens and 20s. The idea of silver costing $100 an ounce seemed impossible to the average investor. But today, with the Shanghai price hitting that mark, the impossible has become the reality. When the COMEX price finally gaps up to meet Shanghai, and it will likely within the next 48 hours, it will trigger a global media frenzy. $100 is a headline that writes itself. It will be on the front page of the Wall Street Journal. It will be the lead story on CNN. And when the public sees silver hits 100, they won't think it is too expensive. They will think, I need to buy it before it goes to 200. This is the paradox of a gift good or of linen good. As the price rises, the demand increases because the rising price confirms the value and the scarcity. The United States Mint has just poured gasoline on this psychological fire. By suspending sales, they have told the public that silver is hard to get. Nothing makes a human being want something more than being told they cannot have it. When the mint finally reopens, whether that is next week or next month, do you think demand will be lower? No, it will be higher. People will be lining up to buy at any price just to secure a piece of the national heritage. So 100 is not the ceiling. 100 is the starting gun for the mania phase, but we must also look at the monetary logic. Why is silver rising? Is it just supply and demand? No, it is the dollar failing. We are watching a real-time devaluation of the United States dollar against hard assets. Gold at $4,622 confirms this. The drain of physical assets from west to east confirms this. We are watching the sovereign crisis move from the bond market to the commodity market. When a government cannot borrow money cheaply and cannot source strategic resources, it is losing its sovereignty. It is losing its control over the economic destiny of the nation. This is why you must hold your position. I know the temptation to sell at 90 or 100 will be extreme. You will look at your gains and feel like a genius. You will want to cash out into dollars to lock in the profit. But you have to ask yourself, what are you locking in? You are locking in a currency that the United States Mint itself is struggling to price. You're locking in a currency that is being rejected by the BRICS nations. You are trading a scarce strategic monetary asset for an infinite depreciating political liability. Do not sell your silver for dollars. The exit strategy remains the same, but it is now more urgent than ever. The strategy is ounces to assets. You hold your silver until the mania creates a distortion in the other direction. You hold until you can trade your ounces for land, for business, for cash-flowing real estate. Right now, at 88.845, silver is just catching up to inflation. It is just waking up. We are nowhere near the peak of purchasing power. Historically, in the 1980 peak, it took roughly 800 ounces of silver to buy the average home in the United States. Today, even at $90, it takes thousands of ounces. We have a long way to go. The ratio of gold to silver is also critical. With gold at 4,622 and silver at 88.845, the ratio is around 52.1. Geologically, it should be 15-1. If silver returns to its natural ratio against gold, the price would be over $300 an ounce. That is the target, $300, until we see the ratio compress, until we see the mania reach a fever pitch, where taxi drivers are giving stock tips about silver miners. The trend is up. The week ahead is going to be chaotic. The banks will try to counterattack. They might hike margins again. They might try to spread rumors that the mint is reopening with plenty of supply. Ignore the rumors. Watch the data. Watch the vaults. Are the ounces coming back into JP Morgan? No, they are leaving. Watch the Shanghai price. Is China selling? No, they are buying. Watch the premiums. Are dealers lowering their prices? No, they are raising them. The fundamentals are locked in. The bridge is burning behind us. There's no going back to the old world of $20 silver. That world is gone. We are entering a new paradigm. A paradigm of resource nationalism and physical scarcity. The United States government just admitted they have a problem. They admitted it by closing the sales window. They showed their hand. Now it is your turn to play your hand. If you have silver, secure it. Do not keep it in a bank safety deposit box. Banks can have holidays too. Keep it in your possession or in a private non-bank vault. If you do not have silver, the window is almost closed. You're fighting for scraps. But even at 90 or 100, buying physical metal is better than holding paper that is burning. The sovereign default at the mint is the signal we have been waiting for. It is the confirmation that the system is broken beyond repair. The wealth transfer is happening. It is moving from those who trust the government to those who trust the metal. The mint is closed. The vault is open, and the price is vertical.